Hi, everyone. Welcome back to the ABA Compliance and Legal Series. Today, we're going to be talking about one of those topics that quietly impacts almost every ABA company, but doesn't always get talked about clearly, and that's entity structuring. We're joined by Matthew Shatzkes from Bochner, chair of the firm's healthcare group, who works with ABA founders and investors every day on how to set up these businesses in a way that actually works as they grow across states and bring in capital. Before we jump in, a quick disclaimer. Matthew's sharing general educational information today. This isn't legal advice, and nothing here creates an attorney-client relationship. Before we jump in, Matthew, is that okay? Anything else you want to say?
Yeah, just thank you for having me. I appreciate the opportunity to speak on the topic. But again, it is important that before anyone decides to jump into any venture, let alone a venture in a highly regulated area, that it's always a good idea to make sure that you consult with legal counsel and are aware of the different considerations and regulatory landscapes and other matters. Just be aware that, again, this is a highly regulated area, and you want to make sure that you're being advised appropriately and accordingly.
Right. Okay. With that said, let's jump right in. So, Matthew, when someone's just getting started in ABA business, what do those early entity structures usually look like in the real world, especially when you've got licensed professionals and non-licensed investors involved together?
Yeah, so it's sort of the threshold question that whenever I have a client that comes to me and says, we want to start an ABA practice or a business, what do I have to do to enter this state or render services in that state? And the reason why it matters is because state laws differ. And because of that, it's going to force you to obviously be aware of those state laws, but it'll impact the structuring when it comes to that business and the structure of it. How do state laws differ? Some states allow for non-BCBAs or non-professionals to own a practice directly. Some allow for joint ownership of different licenses, different professions to co-own practices together. An example, and again, just another license or license type, psychologists and psychiatrists may be allowed to co-own practices in some states, but are not allowed to in others. So that's just, a practical issue there. And then some states won't allow non-licensed personnel in owning that practice. And so when you've got non-licensed people who are involved in the venture, how do you structure around that? And the most common way is through a management arrangement. It's used in ABA practice structuring. It's used in more traditional medical structuring. And essentially the concept is that there's a clear delineation, although there's always some gray, and we can maybe talk about that a little later, but there's a clear delineation between the clinical services and who's responsible for rendering those clinical services and who's responsible for providing the non-clinical administrative services. And typically you'd have the licensed provider on the clinical side, and then you'd have the non-licensed individuals on the management company side. And then from there, it's about structuring a fee arrangement between those two entities that is, one, fair market value for services rendered, because that's going to be a key protection against anti-kickback and other sort of referral arrangement concerns, especially when that management company is also doing marketing services on behalf of the practice, or in this case, the entity that's rendering the ABA services. And the other is being aware of, and we could touch on this a little later as well, but also being aware of other state law issues like fee splitting. Some states don't allow licensed personnel to split fees with non-licensed personnel, and so you can't do a fee splitting arrangement in those scenarios, or a percentage of revenue fee structure. Other states, while they also may have a corporate practice of profession or corporate practice of medicine limitation, which doesn't allow the non-licensed person to own the entity, they may still allow for percentage of revenue arrangements because there is no fee splitting prohibition. So I know there's a lot there, but the bottom line is that there's a lot to take into account when you're considering the best and optimal structure, and that's just for one state. Because unfortunately, if you've got one structure for one state that works, doesn't necessarily mean that it'll work for another state, even if it's right over the bridge, for example, between New York and New Jersey. So different structures, you have to take that into account, and you really got to focus on state laws and be aware of what those look like.
Right. Okay. So that was a lot right there. Let's take this a step back and take it one step at a time. So a typical, or very often, you have somebody, his wife is a BCBA or he knows a BCBA and he wants to be in the ABA business. So these people are not ready for an MSO just yet. And they're just really one person, the non-professional running the business side and the BCBA running the clinical side. Um, is there a way for them to coexist? Like if the investor takes salary or something like that? I mean, is there like a
Yeah.
entry level way to start this very small?
It's possible. Yeah. I mean, again, right. So you'd have to look at state laws and see what type of entity can render ABA services. Does it have to be a professional entity, for example? Does it have to be owned by the BCBA? And then if there is a non-licensed person who obviously has an interest in the business and seeing it grow and succeed, they can be an employee, they can be a contractor of that practice, but there are certain limitations with that. So, for example, they may not be able to have certain titles. Some states can limit who can be an officer or a director of certain professional entities. You may need to be licensed. You may be limited in terms of, again, no distributions. So you might have to pay a little bit differently than you would otherwise. And maybe if it's a husband and wife situation, not as big a deal, because whether it's distributions to one versus salary compensation to the other, it may not matter. But those are some of the considerations. But yes, that is definitely possible. The other thing I would point out is part of the challenge of not setting up an MSOPC structure initially is that if and when you do need to implement it, conceptually it's easy. And a lot of people are like, okay, I'll just form a new company and then just run things through the MSO. But I think legally, it's a lot more challenging. Why? Because you have to move people, you have to move assets, you have to move operations. And so with that comes complexities from an employment perspective, from a tax perspective, if you're the leases, for example, with the practice rather for physical space is with the practice rather than with a management company, you want to move that over, you're likely going to need landlord consent. So conceptually, what you're describing, yes, it's definitely doable, but you have to be conscious of some of the challenges that can otherwise come into play when trying to shift things over and implementing a management company relationship.
Right. I would assume that that's a pretty good trade-off that most business people would like to do when they're starting out and there's just, very little revenue coming in without getting into the MSO thing. And as they expand, when they reach a critical mass where it becomes important, then they're probably more willing to hire an attorney and sort this all out.
It very much depends on the nature of the relationship between the licensed person and the non-licensed. You call them investors or non-licensed personnel, whoever it is that
Mm-hmm.
that have an interest in seeing the practice succeed. Again,
Right.
there will be limitations within the again, with a model where someone is just an employee or contractor directly of the practice. With that said, it is legally compliant and there's ways to structure it. I will also say it's helpful sometimes. Yes, there's more upfront cost in sort of implementing the captive structure, that management structure, but you're also getting out a lot of those more difficult conversations out front as opposed to in the future, again, depending on the nature of the relationship between the licensed person and the non-licensed person about
Right.
what happens in the future, growth, division of responsibilities, which again, other than just clinical and non-clinical, but if we want to sell, if we want to bring on other investors, a lot of those things. Again, sometimes it's better to hash those out earlier on in the process as opposed to later on, where it could just be viewed as you kicking the can down the road.
Right. Which is something we often like to do.
Yeah, yeah. Again, I like to say that a lot of these structures, they're all very similar in terms of their core. So I always just compare it to like ice cream. It's always the same base vanilla, but then what makes different flavors is what you put in it and what you change it to. So it's the same thing, right? I think inherently the core is always, okay, we're aware of a management company and a practice arrangement, but what makes our arrangement unique is what really defines what this looks like. And yes, there's significant overlap between these arrangements, but there's also differences, and those are essentially the negotiated business terms amongst the licensed personnel and the non-licensed personnel.
Right. Okay, so getting back to what you spoke about in terms of every state is its own empire and does things a little bit differently. Is there any specific structure that you ever create that travels well? Sort of one size fits all, maybe the lowest common denominator?
Yeah, so generally the management structure is that structure that works well. I think it works well for a couple of different reasons, and I can touch on those. But I think what I think also has to travel well is not just the implementation of the management structure, but is the fee structure between the management company and the practice. And as I mentioned, certain states have fee splitting prohibitions, which limit the ability to do a percentage of revenue arrangement. And so more often than not, we recommend that, when you're looking at these management arrangements, two structures that travel well are either a fixed fee arrangement. And again, the fixed fee doesn't necessarily just mean that it has to be X amount dollars per month flat. It could mean X amount per provider per month. It could be, in this case, per BCBA or per group of BTs, or a different fee for a BCBA versus a technician. So there's different ways you can vary what that flat fee looks like, but regardless, it's not tied to revenue of the professional entity or the practice. It's just tied to some other fixed metric. Or the other one, and I would say this is more common, and it really depends on the specific services that the practice is rendering, is something called the cost plus model, which is the management company gets reimbursed all of its costs and expenses that it has incurred in connection with providing the non-clinical administrative services to the practice, plus a percentage of those costs and expenses. So not a percentage of revenue generated, but a percentage of the costs and expenses that it has incurred. Regardless of whatever model you put into place, it has to be and should be fair market value for services rendered. Lawyers are not valuation experts. There are separate independent third parties that can provide guidance in terms of, here are the scope of services the management company is providing. Here's what fair market value would look like. Typically, it's a range. And those fee structures seem to travel the best. Again, because if you do a percentage of revenue, you're very likely to run into state law issues that may not allow it, or may allow it in certain instances, but not others, depending on the scope of services that you're looking to provide. So if you're not tying it to revenue, that will travel well. The reason I also like the management structure on a broader level as to why it works is because, like I mentioned, some states don't allow non-professional people to own an entity that's rendering licensed or professional services. And so you could structure something in one state, you as a non-licensed person own that practice, and now you go try to wave into another state, you're not going to be able to. So now you're sort of having to implement a management company relationship anyway. If you didn't have that to begin with, well, now you can't leverage some of the efficiencies and some of the synergies that you would have by using potentially one management company operating in different states. And so having that management company relationships allows you to potentially save money from a employee perspective, cost of billing and technology and all of that other stuff. So I think from my perspective, and it really depends on each individual client or potential clients or businesses, business model, I think you want to maintain as much flexibility as possible. And I think a management relationship with a cost plus or fixed fee structure, I think provides that greatest level of flexibility depending on which states you want to enter when, and gives you that flexibility.
Right. I do want to follow up on fee splitting in a minute, but first I just want to go back for one step and ask is why would, you're talking about a cost plus model or any other model, but if there is a state that I want to go into and they have a much more relaxed laws about fee splitting, why would I give the whole pie away because I am in other states that are stricter about fee splitting?
So typically, and I think this is just virtue of the state law, states with fee splitting happen to be more populated states and more populated states. So, for example, New York has a fee splitting prohibition, and a lot of people who are rendering or want to render ABA services view New York as a state that they want to enter into. Um, I would also say that just because you do a cost plus or a fixed fee model doesn't prohibit you from still effectuating the same economic outcome that you would otherwise have had if you had a percentage of revenue arrangement. So meaning typically the management company's costs and expenses in rendering those non-clinical services just by virtue of the healthcare system, the delay in payments, the ramp up to getting to actually bill for the first time puts the practice in a position where after it pays clinical personnel for their services, it's very likely that most, if not all, of the remaining revenue of the practice will actually get moved over to the management company for purposes of paying its costs and expenses and invoices and or paying back any shortfalls that the management company may have had to pay over to the practice. So when implemented appropriately and in a legally compliant manner, I think most of the time a cost plus or a fixed fee arrangement does still accomplish very similar economic outcomes to a percentage of revenue arrangement. I generally recommend that clients work closely with accountants who have experience or bookkeepers that have experience with operating within the healthcare space so that they're appropriately and able to track those costs and expenses and be able to pull out the necessary amount to make it the business relationship work, but then also accurately reflect what services are being provided and invoices that are being generated.
Right. That's yeah. Well, that sort of covers the problem with fee splitting, right?
Yeah, again,
How do
go for it.
buyers or how does anybody distinguish between a real management fee from a disguised profit extraction?
So again, the concepts of fair market value for services rendered become, I think, critical from that perspective. There's always a question of when do you go and get that fair market value opinion? And I think it's a mixture of a couple of factors. One, risk tolerance. Some people, because it's expensive to go get a third party valuation done. And especially as you're just getting started, and especially if you're new to the business, you don't really fully know or grasp yet what the management company is going to have to incur and services it's going to have to provide. And so I would say many times we have an idea working with the client or their accountant what fair market value would look like, but it's only guardrails. So at some point when you hit a certain size, when you hit a certain minimum number, and again, this is where the risk tolerance comes into play, whether it's services within the practice or revenue numbers or targets or thresholds that you're going to start exceeding, that's when I think it's time to definitely get a valuation opinion. And that'll help protect from this is just a hidden either kickback arrangement and or a fee splitting, circumvention. Um, and and then it's not just getting a fair market value opinion once. You generally want to refresh that every so often. I think most clients do it every 2 to 3 years because, again, there is a cost involved. Or if there's a significant change to the business, for example, opening a new office location or adding a new service line, doing things like that where you want to be cognizant of it.
Or
Again,
to be a
with
drop cynical, if revenue on the clinical side is too high.
Yeah, I mean, so there are some limited tools in the toolbox that could be available to try to achieve that. But again, in my experience, most of the time, the ramp up to getting a practice up and running is such a great expense to the management company that it takes a good number of years for the practice to sort of like dig out of that hole and get to a point where, okay, we're just paying the management fee for this month and we're not paying for services that were rendered prior or advances or loans that were provided or other things like that. So it can happen. But then certainly that's when, yes, you would want to get another another fair market value opinion to see if there's room or areas to increase it. There's also ways maybe to potentially break up what services. Again, cost plus fixed fee, it doesn't have to be a one size fits all. You can break up different services and maybe put some in one bucket, some in another. Ultimately, the entire package has to be fair market value, but there may be other ways to be able to increase what that fee amount looks like in order to be able to pull out, again, in a legally compliant manner, the necessary amounts from the practice.
Right. Drilling down into the MSOs, are there any services that live in the gray zone, which influence turns into control and becomes unauthorized or unallowed services?
Yeah, so I would say it's a little bit clear in the ABA space, but I think there's a good example that you could probably carry over from other medical professional or clinical-like services. A big one that comes to mind is management company dictating the supplies and equipment that'll be used by the practice or the clinical providers. There was an issue in New York where the Attorney General was investigating a management company that was managing dental practices. And essentially, the management company dictated which drill bits the practice can use because they wanted to go with the cheaper alternative, even though the dentists were requesting a higher quality or a different drill bit. And essentially, the Attorney General found, this might not be the right word, but essentially just stated that that was overstepping because it was impacting the clinical decision making and the clinical care that was being rendered by those professionals. And so I think that's a really great example of something that could fall into the gray, where maybe in the ABA world, BCBA says, hey, I need this tool or this piece of equipment or this resource, and the management company is like, no, you don't, or yeah, that one may be better, but this one's more affordable and it's cheaper. But in the BCBA's professional opinion, it's not as high quality. That could be something that I think falls into the gray and that could get someone in trouble. I don't think that alone is enough, but like in conjunction with potential other areas of overstepping or overexertion of control on the clinical side, that could be an area or an example. Another area which comes up is, and again, may not necessarily fully translate to an ABA practice, but you can get the sense, is the idea of like an ultrasound technician or people who are quasi-clinical, right? You don't have to be necessarily licensed to render a clinical, like to render that service or to do that service, but you're also interacting with the patient or you're right, or touching the patient and sort of in that level of interaction. And so I think it's similar here that, again, if there's somebody who maybe, like the technicians is always a great example. Some people are, but you don't have to necessarily be licensed to be a technician, but they're interacting with the practice's clients, patients, and so for that reason, we stick them into the clinical entity. So that's the type of things that you want to be aware of. Ultimately, you want to make sure that there is the separation between the clinical and the non-clinical, and that the management company is not exerting control on the clinical decision making of the BCBA or the ABA practice.
Could you try?
Right. So something like client satisfaction. Would the management company be able to handle that by reaching out to clients and seeing if they're satisfied with the level of service?
So generally, yes. I don't think that falls within the clinical bucket, and arguably it's part of the management company's function of helping the practice effectuate and implement its quality assurance program
Hmm.
or compliance program to make sure, for example, that services were actually rendered in according with with the billing or in the clinical notes. So yeah, the management company has a lot of leeway to help effectuate and implement obligations of the practice. But anything ultimately, you got to remember they are still two separate legal entities. And so when it comes to actual hiring and firing decisions, that should of clinical personnel, that should remain with the owner of the clinical practice. Management company could give their input. Management company can help conduct an investigation or engage in discussions, but ultimately the decision should be made by the clinical owner. And the same thing with implementing and helping effectuate a compliance program, a HIPAA program, a quality assurance program, etc.
Right. Just because I think it's in the mind of a lot of listeners, the case with the dental practice, how did that get to the Attorney General? Was that a whistleblower?
So in that case, it was a significant number of patient complaints
Hmm.
where essentially there were claims made that unnecessary dental work was being done. So unnecessary fillings or other things of that nature. And it turned out that in that case, some of the dentist comp was tied to the number of fillings that they had done. So there may have been some sort of, truth to that in that sense of the feeling of the people that complained. Um, Generally, from a regulator perspective, the way I most see or most common complaints or an investigation commencing is one, a complaint or sometimes unbeknownst, like an innocent, like, hey, I got an EOB. It says I got the service. I have no idea what the service is. And then all of a sudden something opens. So again, something from a patient. The second being a whistleblower, which can always, happen. Or the third is typically either a former or current disgruntled employee who's just not happy. And typically they go to, you know, make a complaint or, start something. Of course, there's a lot of other ways, but I would say those are sort of like the three most common where I would say we see sort of regulatory intervention sort of originating from.
Right. So what are the most common mistakes you see ABA owners making early on when it comes to structuring?
Um, I think the number one thing, and I don't think this is specific to just ABA practices or industry, is trying to cover too much ground too quickly, too fast. Where it's like, okay, we're going to enter into 12 states tomorrow, or some say we're going to go 50 states right away. And obviously, with very good intentions and hopeful for helping individuals that need the services as well as hoping for business success, but ultimately it's a lot to bite off, it's a lot to chew, and it's very hard for people to, I think, successfully um, cover that much ground and implement it so quickly. I think you need to start slower, more targeted approach, really strengthen and build up the relationship with the BCBA that you're going to work with, really understand the regulatory landscape that you're entering into. And the only way you could really do that is by working together with the BCBA, submitting bills, reviewing records, notes, all of those things, because again, what translates in one state may not necessarily translate to another state. And not having that solid base or knowledge, I think, can get you into trouble and ultimately, put the venture at risk. So I would just say be methodical and thoughtful in terms of how you're starting. Things I would look at, one, the relationship with your BCBA. Where are they licensed? That's going to be a factor. Do they have to get licensed in other states? You have to be cognizant of that. Two, your targeted population. Is there a market? Is there a need? How long will it take to get the structure implemented in that state? For example, New York right now, it's taking a very long time to get a professional entity formed. It could take 2 to 3 months. And to my knowledge, you can't expedite that. You can't pay a fee to try to get that expedited. Can it be shorter? Sure, but you got to be thoughtful about that from a from an overall plan perspective. Where do you have people? Where's your other expertises, your resources that are available to you? Where are they located? So those are some of the key things that I would look at. I guess one more I would add is reimbursement rates. Obviously, that's more on the business side, but ability to get onto panels with payers in order to collect, right? Because at the end of the day, you need to be able to do that as well. So a whole bunch of different factors, which I think on some level get thrown into a pot, and then you have to sort of, you as the business and the client need to think about, okay, where's the right place to start so that we can learn this business, do it effectively and legally compliant, and then hopefully growth for success.
Right. Do you see structuring mistakes? Do people come to you after they've structured and you realize that they did it all wrong? What are the typical mistakes that people make?
Yeah, so I think the number one is tied to state laws and state limitations. So some will be like, oh yeah, I'm operating in New York through an LLC, meaning I'm rendering clinical services or ABA services through an LLC. And I'm just like, New York, you can't. Or I own the practice in New York directly, and I'm not a licensed person. Again, can't do it in New York. Oh, but they didn't catch it. That doesn't work. I mean, right, you're going to be subject to clawbacks and paybacks and everything else, both from a payer perspective and other issues with the state potentially. So I would say that's sort of the number one issue that we would deal with. Number two is overstepping on the licensure side. Even if it's a state per se that allows a non-licensed person to own a practice, most states still provide that the clinical decision making should rest with the professional. And so you have to be cognizant of it because it's a very fair and thin line between, well, I'm the owner and I'm legally allowed to be the owner versus, well, this is clinical and this falls under the purview of the BCBA or the licensed individual. So those are, I think, two of the bigger areas that we deal with very commonly. The other is relating to the transfer of or the implementation of the management company. Many times on paper, what people have is compliant, but then when you actually look under the hood and see how they're actually operating, they're not operating that way, which presents a whole set of risks and issues associated with it. And I would say from a regulator's perspective, they will look through whatever a piece of paper says and look at the actual operations. They want to see, are you actually acting in accordance with what the document says? And if you're not, they will essentially throw the piece of paper up in the garbage and say, it doesn't matter what the piece of paper says because you're not honoring that. You're not following that process. So for example, a lot of management companies pay the clinical providers directly. But it's like, no, you can't do that. You can help effectuate payment on behalf of the practice, but it's got to be the practice's account. It's got to be in the practice's name. But it can't come from the management company. So a lot of those type of issues we deal with quite often. Thankfully, most of them are curable, although again, certain bells you can unring. And as time goes on, I think the risk, mitigates and minimizes. But again, there's certain limitations that we have in terms of being able to cure those.
Right. Are there can you define clearly differences between ones that could be remediated and others that can't?
I mean, when it comes to things like paying, like in a way that's not legally compliant, again, we could stop the bleeding, but I can't go back and reissue checks. You can't go back and change things on W-2s and other things like that. So that's I think an example of one, especially when there's tax year issues that you just can't do anything with.
And what would be the fallout of that?
So again, I think it depends on the larger facts and circumstances, right? Meaning if there was a nature of a complaint and the nature was that the practice is really just a facade for these non-licensed people to run this business, I think that's a factor that gets thrown into a, look, this is really what's going on. They're actually paying, the management companies are actually paying these providers and removing the clinical judgment or impacting clinical care and judgment. And so in that scenario, it's obviously not a very helpful fact.
Are we talking about clawback and recoupment in the case like that?
Definitely. I mean, there's a lot of different perspectives when you're dealing with that. One, it could be clawbacks and recoupments from a payer perspective or from a Medicaid program perspective. There could be professional license consequences to the people who, you know, didn't accepted payment from the management company. In New York, technically fee splitting is considered professional misconduct. So
Mhm.
it's on the professional who arguably a greater level of risk. So there's professional issues that could come up with it. Um, Again, there could be kickback issues, potentially depending on other facts and circumstances. Again, this isn't meant to scare anybody, but it really is fact intensive in terms of what exists. And again, all of these things can help be used against a management company and a practice to build a case or prove a negative or a positive, depending on what the nature, that exists.
Right. So we spoke about audits and we talked about licensing. Let's talk about exits for a minute. How would all this impact an exit and valuation or just even losing the deal? What are buyers looking for? What's a showstopper for them? And what would they just like retrade the value when they dig all this up during diligence?
Yeah. So I think it's when I speak with clients, a lot of sort of the early structuring discussions, obviously they think exit's very far away, and it is, but I think similar to how you want to maintain flexibility in terms of entering into different states and scaling and growing the business. I think you also want to maintain flexibility and being as attractive and appealable to as many potential buyers as possible from an exit perspective. So what do I mean by that, right? Your potential buyer could be another BCBA husband and wife team that, is like, oh, I'm ready to start a business. Or it could be an institutional investor, whether that's a private equity firm or some other sort of strategic or another ABA practice, right? That's just looking to grow from that perspective. And so I think being thoughtful about your structure now helps you be as attractive to those different potential buyers in the future. And the one that I pick on the most, when I'm speaking with clients about this is the institutional investor. Most institutional investors, and again, we'll just stick with a private equity firm, generally don't have an interest in being an owner of a professional entity. It comes with a lot more risk. It comes with a lot more headaches. In terms of, you're now 1 degree of separation from patients, which means there could be malpractice. You're also directly communicating with payers, you're directly communicating with regulators and all of that type of stuff because you're the owner of the practice. In my experience, most of those institutional investors like the idea of a management structure and like owning a management company where they're further removed. Um, and and so you're not only just getting the flexibility of doing this in different states, but you're also being more attractive to those, potential institutional investors that like that model, that even if they could own it directly, would still implement a management structure in those states. So
Right.
to me, that's another advantage of, that sort of the MSO practice structure. But those would be some of the things to be cognizant of. A lot of the challenges that we deal with when it comes to clients on an exit, listen, things happen along the ways, and I would say a lot of times there's side letter agreements or other sort of arrangements that are entered into, and they're not necessarily properly filed with the state, or they're not official owners of the company, they're phantom owners of the company, for lack of a better term. And then that just, again, it impacts who your buyers could be, because some buyers may say, I don't like this. Like, I don't want to get involved. I don't know who really owns it, who's not. I don't want to get into a fight one way or the other. And then also they may require, in those situations for all of that to be cleaned up prior to a closing. So that can impact the transaction. Um, or they presumably could walk away. It's definitely very possible. And then lastly, there's tax implications, right? Like in those types of arrangements where you may not, and I'm not a tax accountant, but or a tax attorney, but when you're you're not an official owner, but you've got some sort of like phantom equity arrangement and other things like that can all impact it. So those are things that we commonly deal with. But again, I'd still believe that the management structure is one that's more attractive to your greater potential pool of buyers as opposed to we just have a practice.
Right. Well, that was awesome. Any closing words, or you got it all
No,
out?
no, again, I would just echo what I started with, right? It's a regulated area. Um, it's obviously an area that presents a lot of opportunity, but if you're interested in expanding, you're interested in starting, you're interested in implementing a management arrangement, whatever the case may be, this isn't intended to be an exhaustive discussion of all of the considerations to be thoughtful of, but it is I think hopefully a helpful starting point. But you should, again, consult with your own independent counsel and advisors before you jump into it.
Right. Okay. This was very practical, and I appreciate you grounding these issues and the way they actually play out for ABA operators over time. I just want to say a word about NUCO. We handle entity formation, registered agent service, and ongoing compliance nationwide, which is why ABA is a target market of ours. These conversations that we have are not because we're in the ABA business, but we want to make sure that we're serving our clients who operate in complex industries, not just processing their filings. I just want to let you know, I've written a new book called Compliance as a System, How ABA Clinics Really Control Risk, Revenue, and Survival, which builds on many of the themes we discussed today. If you're interested, feel free to reach out to me by email. We have more episodes coming up in the ABA Compliance and Legal series that are focused on payer risk, audits, and operational compliance. Thanks for joining us today, and we hope to see you on our next